What's going on, guys? Welcome back to another video. In this video, I've got another very important AMC update to bring all of you this afternoon. So what we're going to be covering in this video is first, another explanation on exactly what forced share recalls are. I've seen so much confusion circulating around the internet on exactly who can perform one of these forced share recalls, exactly what happens when these shares are forcibly recalled, and what it does to the share price of a stock, specifically in this situation for AMC. So that is something that we are going to cover. And second, we have an update on this automatic margin call rule. Now, there's NSCC 002, which essentially allows the National Securities Clearing Corporation to issue margin calls every single day rather than only around the times of monthly options expirations. But this other rule, NSCC 005, allows for a one-time boost of the initial margin requirement at the National Securities Clearing Corporation from $10,000 all the way up to $250,000. Now, that may not seem like a lot for a lot of these big institutions, but there are a couple of different hedge funds, one in particular, that are very upset that this rule is coming into effect. They are throwing a fit about this, and I want to show you guys not only the information and complaints that they have about NSCC 005, but some additional information about settlement dates and some other things as well that they mention in this comment section. So before we get into all of that information, if you enjoyed the information and analysis that I provide for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you want to see more videos like this, make sure you hit that subscribe button. So at the current time that I'm recording, AMC is having an awesome day. We are up about 6% right now, trading at $33.43. Now, coming over to Ortex, we can see that the borrowed shares today for AMC, 7.3 million shares. The borrowed change, a net borrow for AMC shares of 3.5 million. Now, we did see the utilization slightly decrease from yesterday going into today, but again, I am seeing a trend on this utilization going upwards, and when we get up to those higher levels of utilization above 98%, that is when we could start to see this concept of forced share recalls come into effect. So what exactly is a forced share recall? Well, there are a couple of different things we need to understand about this. The first, AMC, the company, I want to make this very clear to everybody. AMC, the company, cannot issue a forced share recall. After they sell these shares, they are no longer owned by AMC. It is the lenders of the security, so the prime brokers, the banking institutions, or any other institution that wants to loan out shares. It is up to them if they want to perform one of these forced share recalls. Now, something else we need to understand, and something that I have brought up a couple of times, is that lenders can recall their shares. Again, this is from BNY Mellon. Lenders can recall their securities whenever they want, for whatever reason they want, and they do not have to provide an explanation. So when we think about a forced share recall, what happens is that sometimes these institutions can't get their hands on more shares to lend out. That creates the scarcity aspect of shares that we have been talking about, increases the cost to borrow rates, and if the institutions who are lending out shares can call those shares back, force the clients to cover their positions in a forced buy-in situation, then they can re-loan out those shares at a higher cost and make more money. So that is similar to what we saw back in June, as we can see here. So once we see the utilization get up to those higher levels, that is when, in my mind, we are going to think, okay, game on. We could be at these high utilization levels for a significant period of time. The last time it was about a month, but eventually we will see something happen. Now, let's get into this automatic margin call rule, one part of these series of rule changes that lead the way to higher margin requirements. Now, as we're gonna see later in this video, in Q4, the DTCC could be jacking up these margin requirements way higher than they already are at right now. So when we come over to this new filing, we can see that, therefore, the NSCC proposes to increase its minimum required fund deposit from $10,000 to $250,000. As we can see right here, this is essentially the summary of this proposed rule change, and we have known that for a while. But when we come back up to the top, we can see that it has been essentially filed for immediate or accelerated approval. So what this means is that within the next month, this rule should come into effect. Now, there's about 3,000 plus members of the National Securities Clearing Corporation, so that would bring in about over $850 million for the National Securities Clearing Corporation in terms of these minimum required fund deposits. What they're doing here is basically doing a one-time margin call saying, hey, everybody that is trading with us, we need you to give us more money, more collateral in order to maintain your membership status. Now, coming over here, this was one of the comments that was submitted on behalf of a corporation called Alpine. Now, I have copied and pasted this document over onto a Google Doc and highlighted the key important pieces that we need to know. This firm in particular is very upset that this proposed rule change is going to affect. Now, this is slightly older, but what we saw here was this firm represents Alpine Securities Corporation. We submit this comment letter on behalf of Alpine in response to the NSCC proposed rule change referenced above, seeking to increase the minimum required fund deposit imposed on members from $10,000 to $250,000. So we know that this comment now is referring to NSCC 005. Now, it is NSCC's margin charges, after all, that led to the highly publicized recent events relating to Robinhood, and which forced Robinhood to raise more than $1 billion overnight to meet the NSCC's margin calls, and even then to restrict trading by its customers because it was unable to satisfy the accompanying deposit requirements. So what they're essentially doing here is blaming the NSCC for actually enforcing these margin calls. So this is very backwards. It is NSCC's job to enforce these proposed rule changes, and if their members are unable to come up with the money that they essentially owe the National Securities Clearing Corporation from being a member of this corporation, it is not the NSCC's fault. Now, when we come down a little bit further, there are a couple of other things that we need to mention as well. Monetizing risk is simply not an efficient mitigation strategy as compared to its technologically feasible solution. The proposed rule change impermissibly targets and disproportionately impacts smaller, less desirable NSCC members on its face. The proposed rule change is extreme. It proposes a 2,500% increase to the minimum required fund deposit. It is also designed to disproportionately impact small broker-dealer members with more limited capital resources because only small firms may struggle to post the $250,000 minimum or have the more limited trading activity that would allow them to operate with a required fund deposit near or at the minimum. Now, when you think about this statement right here, why does Alpine care about the other members? The hedge fund world and the trading world is wildly competitive. If they were to see that their members and their competitors were actually to be impacted by this rule, they would eat that up. They would be extremely excited. So it doesn't make a lot of sense here why they're complaining against this rule. Now, Alpine is within the target zone of the proposed rule change. Again, so they don't really care about this. Although Alpine is not directly impacted at this time, only because NSCC currently requires Alpine to maintain a required fund deposit over $3 million plus daily and intraday margin calls that take Alpine's margin obligations to NSCC far over that amount, and which invariably exceed the value of the underlying transactions. Of particular concern to Alpine, however, is that the NSCC is pursuing this increase as a baby step towards an even greater increase down the road. This is a very good thing right here. So they are kind of suggesting to us that these margin requirements are going to go up. So let's read a little bit further. This is not an idle concern. On two separate occasions this year, representatives from DTCC have informed Alpine that the NSCC plans to seek an increase in the minimum capital requirement to $10 million for corresponding clearing firms such as Alpine, and that NSCC expects that change will be implemented in the fourth quarter of this year. Now, this kind of plays in to everything that we have been talking about on this channel. We know everybody is over leveraged. We know that these margin requirements are continuously increasing, and that Q4 could provide for a very interesting market disruptive event. And we are seeing right here that they are even expecting to increase these margin requirements ahead of a major disruptive event. Now, Alpine actually mentions an event coming down a little bit further in which they got margin called and they were struggling to come up with the money in order to maintain these maintenance margin requirements. Now, boo-hoo is what I have to say to that. If you enter into an agreement with your basically securities clearing corporation that if in the event that you fall below a certain margin requirement and then you're going to complain to them about the difficulties of coming up with that money, that is not the NSCC's fault. That is your own fault. Now, the last thing that I really want to mention that is mentioned in this complaint, essentially in this comment section, is this coming down here. The DTCC acknowledged that the most logical way to reduce risks that drive margin requirements is to shorten the settlement cycle, and indicated that its goal was to move the United States to at least a T+1 settlement by 2023 and even shorter thereafter. So this is an unbelievable step in the right direction that I don't think a lot of people have really talked about, and it has not really been made public. The DTCC looks to be trying to decrease the settlement times. Now, there have been a lot of different debates on what these settlement times are going to be, and there's been a lot of fight on decreasing these settlement times in the past, but going to T1 and then down to T0 would be a major step in the right direction for not only making our markets more fair, but giving retail investors the ability to make trades without really worrying about where their trades are necessarily going, or if they are being quote unquote delayed by getting filled or cleared by the Securities Clearing Corporation. So that is going to wrap up this update on AMC. I know we had a lot of information to cover in this video, so make sure you go comment down below if you have any questions about anything that we went over. So if you enjoyed the information and analysis that I provided for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video, so you get to stay up to date on all of your favorite stocks, learn about a couple of new ones, and see exactly which options I am trading and which strategies I am using to trade them. So I hope you guys are having a great day, and I'll see you guys in the next video.